Welcome back, everyone. China's booming economy is expected to consume half of the world's key resources within a decade, but that's not all the country wants to own. Bloomberg Gigi Stone here to explain more on that. Gigi.
Carol, we're talking about China's $300 billion sovereign wealth fund. It sat out most of last year. It may now be looking to buy up one of our most distressed markets, commercial real estate. Now, according to reports, the China Investment Corporation is in talks with private groups like BlackRock and Invesco to buy mortgage securities with the help of the Public-Private Investment Program, PPIP. Some U.S. real estate executives are hoping this will prop up values, and they're lobbying to amend tax law to encourage bringing in overseas capital. Now, I spoke with Chip Rogers of the Real Estate Roundtable. He says stabilizing real estate markets nationally and helping turn the American economy positive will require trillions of dollars of new equity investments, and that it makes sense to review and update old tax laws that unnecessarily discourage global investment from flowing into the U.S. Now, there may be some political protest out there since some lawmakers already blame China for helping create the credit bubble by investing heavily in the U.S. government, and big foreign acquisitions of U.S. property have led to political backlash in the past. You can't forget the 80s when Japan bought Rockefeller Center. There was a little political backlash there.
There was a lot. All right, Gigi, thank you. Matt.
Never forget that, Gigi and Carol. We're going to talk about that a little bit right now. For more on commercial real estate here in the U.S., we're joined by Sam Chandan, chief economist at Real Estate Econometrics, if I can get it out. He is joining us live via camera from Wharton at Penn. Also, Craig Evans, director of investment sales at Colliers, joins us here in the studio. Sam, let me start with you and ask you about something that Gigi touched on here, because we were talking about this earlier. You automatically think of, the early 90s and the late 80s when Japan started buying up real estate here. Will we have a different kind of reaction this time, because there was a slightly xenophobic reaction at the time to that?
I think you're right, Matt. There was some degree of anxiety in the 80s when some of the assets in New York, particularly the very visible assets like Rockefeller Center, were being bought up by Japanese investors. I think this time, participants in commercial markets, owners of assets, and potential investors in assets appreciate to an even greater degree than we have in the past that there are downward pressures on pricing. Many of the investors that we might count on to drive dollars into the market in the United States depend on the availability of credit, and that is obviously a constrained market. Banks are limited in their ability, capacity, and willingness to extend new credit in commercial real estate right now, and that has tempered the level of activity to the extent that we might see investors from China, but also from other countries, Germany, Australia, Canada, the United Kingdom, bringing equity into the market and not depending heavily upon the availability of credit or leverage to purchase assets. It has the potential to really support the market and reinvigorate activity.
All right, and this is something that, Craig, you and I were talking about this earlier today. You were saying the same thing, really, that the lack of credit has been one of the major problems here as far as trying to find a pickup in the real estate situation. Do you see, you have your feet on the ground here in this market. Do you see foreign money coming in to a greater extent than, say, it had been at the earlier part of this year or the end of last year?
There's foreign investors calling us on a regular basis looking for deals in Manhattan. The prices have gone from the peak of $1,000 a square foot in the case of Worldwide Plaza down to a bit over around $310 a square foot.
So almost a 75% drop in that case.
But you wouldn't generalize that to the overall market. It reflects a specific property. But it's a more opportune time to take advantage of the market. And there are accumulators of capital all over the world. It's not just foreign investors. Foreign investors have not made up more than 20% of the buyers in the U.S. over the last 10 years. And now it's around 10%. It's ticked up a little bit, but the volume of sales are down over 90% from where they were at the peak.
But one thing you were talking about earlier is the fact that all this money's coming in here. You're getting calls from these guys, but there's just not a lot that's for sale right now.
That's right. A lot of the banks or holders of assets do not want to recognize gains. Those who can hold them know that this is a terrible time to sell. A lot of them are looking to buy notes at a discount. or REO or foreclosed assets, and you look at Deutsche Bank and the sales that they did, and right when they started foreclosing Harry's properties, the two sales took place, Tower 56 and a building on Madison Avenue, at about $1,000 a square foot, and that they were very proactive. That was very smart on their part because they got it before it was tanking dramatically, and the last sale was, as I said, at about $310 a square foot.
Sam, what kind of inflow could we see if the floodgates are open? I mean, Craig is saying they're getting a lot of calls. People want to spend the money, but they can't. Are we going to see a shift in these sovereign wealth funds from holding U.S. Treasuries into more real estate and more hard assets?
I think that, when we look at the volume of capital that might flow into commercial real estate, it's small as compared to the investments that are made in Treasuries or in Fannie Mae and Freddie Mac bonds. But it's significant in terms of the level of activity that we see right now in the market. The data from Real Capital tells us that, at its peak, we had about $25 billion of foreign investment come into the United States, into commercial real estate assets. And I think that at this point, given the types of declines that we've seen and the constraints on the availability of credit, even relatively small infusions of capital as compared to where we were at the peak are going to be helpful in terms of lubricating activity, helping to support the process of price discovery and getting people more comfortable with the types of price adjustments that have yet to be observed, given that we only otherwise have distressed asset sales to look at. Where I think we do need to be very careful is in understanding that foreign investors, while they now rank Washington, D.C., New York, San Francisco as amongst the key targets globally for investment, we are talking about a very limited set of metropolitan areas. We're talking about core assets, Class A assets in some of the most visible, some of the most liquid markets in the country in terms of the diversity of investors. It's not necessarily the case that some of the secondary, tertiary, smaller markets towards the interior of the country are going to see the benefit of this in the same way that a New York or a Washington, D.C. will.
Craig, do you think, though, that this could help? I mean, you state that third-party lending not moving much is one of the big problems here. Could this really help lubricate the system, as Sam is pointing out?
Every little bit helps. What's critical is that the lending increases.
Do you see that happening at all, by the way?
Well,
we hear about credit markets thawing all the time.
Smaller loans, smaller banks, regional banks, they had been held out as people who are continuing to make loans, but there's very low volume of loans being made right now, and it's critical that the debt markets recover. And how's that going to happen? The banks have to have confidence in the capital adequacy to make additional loans. Secondly, you have to be able to underwrite the properties. And as vacancy rates continue high, you're going to have continued pressure on rents. And who knows how much further those rents will go down and undermine even current values. And they have to have confidence.
All right, Craig, thanks so much for joining us. Craig Evans there from Colliers. Sam Chandan from Real Estate Econometrics, thanks so much for joining us.